Can the Federal Reserve thread this needle and bring down inflation without a recession? We think so, but it will need some luck. Consider what a bind it is in now. Inflation is roaring with the consumer price index up 8.5% in March, the biggest jump in 40 years. Now, let me put this in perspective for you, okay? If you do what the Kiplinger says, and you put your $100,000, let's use that as a number, you put your $100,000 in any one of the investment vehicles that they recommend, your $100,000, because of inflation, is worth $101,200. Because inflation has eaten away the value of your dollar. If you had put your $100,000 in real estate, without doing anything, the value of your real estate is now worth $108,200. Do you see that? So the way you curb inflation is through real property, because a rising tide lifts all boats. So when inflation goes up and the dollar weakens, real estate values rise. So when your investments are in real estate or real estate-backed assets, like our private equity funds, inflation actually benefits you. But if you have all of your money in what they suggest, inflation kills you. Inflation is roaring. The Fed has little choice but to hike rates given how high inflation has gotten. Look for a series of 3 half-point boosts. This is something you should all write down. 3 half-point boosts, okay? For every 50 bips in basis points that the Fed increases, your buying power for housing goes down $26,000, okay? So if there's 3 boosts this year, if you're qualified right now for a $400,000 house, by the end of the year, you will only be able to afford a $325,000 house. Just with these 3 increases. That's a 1.5% increase on your cost of capital. So they are anticipating an increase in May, another one in June, and a third one in July. Which means if you try to buy a house in July, your interest rate's going to be 5.5% or higher. I have a rate on my house at 3%. So 3% to 5.5%? I couldn't even afford my house at 5.5%. I could, but I'm being dramatic. All this means is that borrowers face higher interest rates in the coming months. The bank prime rate will rise in lockstep with the Fed's own benchmark that in turn will push up rates on home equity lines of credit, auto loans, credit cards, and other forms of consumer credit. 30-year mortgage rates are less likely to crest 5.5% from 5% now, however they may pull back. Now, am I concerned about inflation? No, because when inflation hits, guess what? We raise our rates in COGO. Okay? All rates rise. Rising tide lifts all boats, so we'll see increased rates in COGO. Does that mean we're going to make less profit on real estate? No, because we don't care about the cost of capital. This is what our clients need to know. This is why when they come to Lee's Inner Circle, they do 4 deals to get their money back, because we teach them that the rate doesn't matter. If the rate is 8 or the rate is 18, do you care if you're going to walk away with 30 grand in profit? What do you care? The only people this affects is consumers, okay? People who make their money at their job, do nothing else, that's who gets killed by this. Investors, we don't care. We just adjust. We shuck, we jive, we move. This is what we teach our clients.